We all know that the stock market is a complex, interrelated system of large as well as small investors who are making uncoordinated decisions about a huge variety of investments. I would say that this is an ecosystem in which each market participant acts freely using their individual ideas and by following their personal interests. And the market is basically a shorthand for the collective values of various individuals and companies. Well, this market is now failing, and yeah, it is time to panic now. What's up, guys? Welcome back to Glory Investing Show. In our today's video, I'm going to tell you about why the stock market is going down and why you should be worried. Moreover, we will also discuss what you need to do. However, before we go any further, make sure to smash that like button. Now, without further ado, let's get into this. According to a report published by CNN Business on September 17, 2021, it's been a wobbly week on Wall Street, and CNN Business's Fear and Greed Index is flashing fear. The stock market is in a weird place. It has fallen in most of the trading sessions this month. The S&P 500, which is the broadest measure of the US stock market, only has 4 high closes this month, and one of those was more or less flat. Meanwhile, the Fear and Greed Index is sitting at 35, which signals fear. However, it is important to note that the S&P 500 is only around 2% below its all-time peak. Now the question is, what is actually going on with the stock market? Let me tell you that inflation is taking a breather. In August of this year, the Dow Jones Industrial Average fell more than 380 points in a single day. And many analysts are now worried that the stock market could be in for a correction. This means that you can expect a slump of around 10% or even more. A report published by CNBC on August 19th of this year states, while volatility can be troubling for investors, experts caution against any hasty selling when markets fall or trying to time a market correction. In addition, slumping stock prices can be a prime buying opportunity that investors should take advantage of. With that being said, let's discuss volatility. First of all, you need to understand that volatility is common. It is a normal part of the investing process. There is no guarantee that the stock you're investing in will rise or fall in the future. Experts only predict the future price of a stock after considering various factors. So how do you outrun inflation? A certified financial planner named Brad Lineberger, who is also the president of Carlsbad, a California-based seaside wealth management, states, "Embrace the volatility because it's why investors are getting paid to own stocks." It is important to note that Carlsbad manages around $165 million in assets. Now you have admitted the fact that the stock market is failing. We need to discuss what should be your strategy. Experts suggest that investors need to stay calm. If you stay calm through extreme movements, there are higher chances that you will become successful. You need to focus on long-term market returns. Why? Because the long-term market returns are still based on the same things, such as earnings growth, dividend yields, and change in valuation. Moreover, these extreme movements can also be a good opportunity for you to review your asset allocation. And if you're worried that one of your stocks might experience a massive drop, you could rotate the part of your portfolio into less risky stock. It will help protect you against a potential market correction. And moreover, many analysts say that it can be a good time to buy more stocks. You could indeed set yourself up for future gains. Why? Because when stocks fall from recent highs, they're basically trading at a discount. You will buy stocks at a lesser price, and these stocks are more likely to rebound at some point in the future. This means that you can set yourself up for larger returns. The report published by CNBC states, "Continuing to put money in the market when it's down as opposed to selling is a great way to make sure you don't miss out on a rebound. Data shows that selling when the market goes down can take you out of the game for some of the strongest rebounds. For instance, you had missed the best 20 days of the S&P during the last years, your average annual return would shrink to just 0.1%. On the other hand, if you hadn't missed these 20 days, you would have earned 6%. Yes, volatility can benefit you in the long term, but you still need to have a cash emergency fund on hand. It will help you make it through a market meltdown without selling. Suppose if the stock market falls and you don't have an emergency fund. Well, Chief Operations Office and Senior Wealth Advisor at Strategic Wealth Partners, Tony Zabiegala, says that if the stock market falls, it's better to spend the money in your emergency fund than to sell assets at a loss. Having an emergency fund will also keep your stock investments in the game for big rebounds. You might be thinking about how much money you should have in your emergency fund. Well, experts suggest that investors should have enough money to survive 3 to 6 months of living expenses in their emergency funds in order to avoid taking losses. And lastly, you need to create a plan. What's even more important is that you should stick to that plan. Well, we can say that sticking to your plan is generally the best thing you can do to save yourself and you should never panic because you will end up selling too soon. Instead, stay calm and focus on creating a better plan. However, if you're a person who is planning to retire soon, you should focus on protecting your assets instead of aiming for the highest return. According to a CFP with Madison Financial Planning Group in Syracuse, New York, Leila Murgillo, managing the risk is a really important part. It's not about trying to shoot for the highest rate of return you can, it's about protecting what you have. If you want to stay committed to a goal, you need to make a roadmap for retirement investing long before you leave the workforce. And the most important thing is to diversify your portfolio. If you have invested money across different baskets of asset classes, your results will vary for the better. In simple words, if you have appropriate asset allocation, it can help you reduce investment risk. Moreover, adding diversification within an asset class takes it one step further. It will indeed smooth the ride through a tumultuous market. Moreover, you also need to do your research. Write the strengths and weaknesses of your investments. It will help you figure out things that you should not sell. In the end, let me tell you that many investors fail because of their self-doubts and ill-advised tactics. So it's important to consult an expert. Hiring a financial advisor is always an excellent idea if you want to diversify your portfolio and protect yourself against market corrections. Furthermore, you will have an independent perspective on your financial plan. That's all for today's video, guys, and thanks for watching it. If you liked it, make sure you give it a thumbs up, and if you have not already subscribed to Glory Investing Show, subscribe to it and press that bell button so you will be notified each time we upload an interesting video. And while you're here, click to watch one of these two videos that are appearing on your screen. We'll see you there. Take care and stay tuned.